Greetings, everybody. This is Jeff Scott, and I'm back home, and this is my weekend review for September 15th, 2019, and it's a few moments after midnight, so clearly no futures are out yet. I titled today, Do Falling Bond Prices Suggest New Highs Are Ahead? I think they are. Let's take a look at the markets. As always, this is for educational purposes only. I'm a doctor, not a broker. I have no licenses that would allow me to trade for you or tell you what to do. Anything you do is on your own. Anything I suggest is only for education. I am independent. I've paid for all my tools, and trading involves risk. You and you alone are solely responsible for any decisions you make. From time to time, I discuss the use of options, and options are considered to be risky, and I refer you to the Options Educational Council and Industry Council so you can learn the pros, cons, and true risks of trading options. From time to time, I do educational events. Almost every week, I do one of these webinars, and I call my educational programs Be Your Own Guru. On this page are a number of the folks that I've learned from, starting with Can Slim, improved by Woodward and Brown, Morales and Katcher. John Person really taught me how to trade. Position Size Money Management by Van Tharp, the Q Tools from Cigar, and then my buddy George Lee. I've had a lot of questions about when or if I'm going to do an education event this year. I don't have anything to sell, so I've done the programs because I enjoy doing them, but frankly, I'm busy at work. I don't have time to organize my own program, so I am not going to be doing a program in South Florida this year. However, George Lee has asked me to participate in a program that he is doing in Vegas. I have not seen any invites as of yet. It is scheduled the 6th, 7th, and 8th of, let me get the dates again, I'm sorry, the 3rd, 4th, and 5th of November. So let's stay tuned to that. Hopefully he'll be sending invites out soon. I plan on spending a lot of time at the podium there, but have no other plans for any podium presentations the rest of this year. I have a lot of things on this computer. Actually, this has the least because it's only for doing the videos. And mostly I live in TradeStation, Thinkorswim, and my various indicator packages, and then HGSI and EdgeRater and the Superior Profit Tools. Speaking of HGSI, if you go to the website, there's a free 30-day trial. They don't even require a credit card. And under investing strategies, you'll see hundreds of videos by myself, Ron Brown, and others. I always have to ask the question, where are we in the market cycle? And it's really been for some time that it's felt like we've truncated the top of this. Every time it looks like we're going down, we run up. Every time it feels like we might break out to new highs, we pull back. We may be breaking out of the cycle here, and we'll talk about that as we go on. Since I've become more bullish, I've increased my positions. I've bought some stocks and calls. I've taken off much, but not all of my protection. I still protect Amazon a little bit after last year, and I sell premium out of the money puts and calls to pay for the at the money puts that I carry on Amazon. It mitigates some of the growth in my account, but it protects it from what happened last fall. But I'm at a position now where I'm thinking about taking that protection off. Friday's sector review, the key things here is that defensive plays started having problems, whether we look at staples, utilities, or real estate. So clearly the market has been strong the last 2 weeks, but defensive plays are starting to ease off. There's been very pronounced rotation, and it feels like the worst stocks have been leading over the last couple of weeks as we've shifted from growth to value. If we take a look in Thinkorswim at the major markets, why don't we do that? Come on, there we go. So here's the E-mini futures. You could see the high of the year was not that long ago. It was July 29th. And it looks like here's a buy signal from John Person Indicators that came out on Thursday. And it really looks like we want to go out and challenge those highs. Hard not to be bullish looking at this chart. And it feels like this pullback that we've just gone through in August and early September was similar to the one of May and not December of last year. And these things occur frequently over time, and more of a pause before we go on to higher highs. If I look at the NASDAQ futures, a similar pattern, a buy signal came in on Friday, and again, holding above the 50-day moving average here, and looks very different than it did back here in December. If I look at the Dow futures, again, recent high here was on July 29th. We're in a buy signal above the major index moving averages, and certainly look like we're poised to go and threaten past highs there. Now, the best news of the week is that even though the Russell is still lagging, and the others are up here challenging old highs, the Russell's had a big move and has a buy signal itself. That may be the best thing that I saw this week, and that suggests that this market may have more to go. Maybe you don't get a new high on the Russell, but if we can challenge new highs on the Russell, that really suggests positive things for the market going forward, at least in the near term. The VIX has come down to a level where you see complacency, and then the dollar has gone sideways here and pulled back Thursday and Friday. So the markets have changed, and it feels like we're maybe moving out of this chop and perhaps going to move on and challenge new highs. Here is the monthlies, and the weeklies, and you just see the super long uptrend that we've been and the lagging of the Russell here. Now, what else is important? Notice the curve up here. Rates rocketed higher on both the 10-year and the 30-year. And in fact, if you could see here, you'd see that we bounced off the inversion line and we've become less flat on the rate curve, or less, we've moved away from inversion. That's a very bullish sign to me. And as it says here, rising rates, sorry about that, are good for banks, especially regionals and insurers, and I clearly saw that on my top-down review. AD lines, hard to see a difference between white and yellow, but they're both setting new highs on both small stocks and large stocks. And you can see it better here where the white on black is the NYSE AD line out to an all-time high. And everything is moved up on the major market ETFs, including transports. Now what's rocketed down here is TLT. So bonds are easing in the setting of rising rates. Now breadth also has broken out here, and you can see both stocks above the 200 and above the 40-day have increased. That is a bullish signal for the market, and we're not at the point of obvious reversal on the 3-month new high, new low. The daily McClellan, we'll see if we get new highs here. We've broken through the descending trend lines on the oscillator and the summation index on both the daily and the weekly. Current buckets, 81% of the stocks in the S&P 1500 were trading above their midline, bullish, and 20% are above the upper band. That can go further, and we'll see how we do. That does not have as strong of a signal as we would if this was on the bottom. No Hindenburgs, you would not expect them again until we have new highs or get back up to, to a prolonged area where we are today. But you could see the last couple of times, especially on the NYSE, when we've had a series of Hindenburgs, have resulted in substantial pullbacks. Market tone, if we go down here, you can see all the major indexes are green on the Woody indicator. So markets are bullish. And if we looked at the sectors, the weakness is in staples, utilities, and real estate. Canaries in the coal mine, interestingly, have broken above their chandelier stop and above their major moving averages. We'll see if they can get any momentum. I think if the market is going to go higher, you're going to have Amazon, Google, Facebook, Netflix participate. What is interesting and perhaps not surprising is the leaders from March have not moved up. So we are seeing rotation. We're seeing rotation into some stocks that were laggards. But this, to me, is the best evidence, and this is probably the last time you see the March 3rd leaders because they no longer are leading. Fed meeting announcement and speech Wednesday, that's the dominant factor. If you look at the news flow this week, you have some industrial production on Tuesday. Housing starts in energy early Wednesday, but the big kicker is the FOMC meeting announcement at 2 p.m. and then the 2:30 Fed head Powell conference. He has a unique ability to take a bullish sounding report from the FOMC meeting and cause the markets to sell off. So we'll see what happens. Got some jobless claims on Thursday and quadruple riching on Friday. So news flow is clearly going to drive the markets. There are some earnings, but really a light earnings week. So my thoughts, markets continue to churn higher with plenty of damage underneath the indices. Just look at the software stocks. Massive market rotation as the biggest laggers lead the last couple of weeks. High profile leaders and growth stocks hammered, bonds and metals fall as markets rise. News flow, the Fed I mentioned, this weekend there were some attacks on Saudi oil fields, and China will continue to whipsaw markets, but the major indices do seem headed to new highs, with the small stocks finally starting to participate. For the bulls, the big move in yields and drop in bond prices may be just the stimulus to drive us to new highs, yet each morning likely to bring tweets from the White House, which always can derail or pump up the markets. Based upon current conditions, I put more money to work, continue to wind out of any defensive positions. All right, take a look at the market from a top-down perspective, show you one of the stocks that I'll be interested in on Monday if things hold up the way they are right now, and we'll make this hopefully not a super long session. If we look at TradeStation, which I have that 6-point review to see what I think the markets are doing, let's take a look at the E-minis. So what do I see on the E-minis? I see we're in a buy signal on the daily, the weekly, and the monthly. That's good. We've got a blue bar here and this red dot that suggests we're having some MACD divergence. So we're having a lower high on the MACD despite a higher high on price. I look down here, we're at 94% on the high jump, so we're getting to a point where reversals could occur. Our weekly bongo is green, so I'm bullish on this picture, but a little concerned about that red dot. But I also acknowledge that that red dot and the high jump could take several more days before it's a problem. If I look at the Dow Jones Industrial, similar picture with a blue bar here, weekly across all three, 95% on the high jump, and the weekly bongo is green. The NASDAQ, also a blue bar, 86%, weekly bongo's green. And the Russell, actually short-term even more overbought as it's gone above its outer envelope. In a buy signal, notice the green everywhere, but look at the Russell. Interestingly, it's at 99% on the high jump. When stocks or indices are at 99%, that says they're the most extended they are over the last 200 bars, and typically something that doesn't occur often, and it's a place we often see a reversal. So we are getting long in the tooth over the last couple of weeks, so a little pause would not be a big shocker. If I look at the dollar, you can see the dollar is red, but interestingly did get a buy signal on Wednesday. You can see the MACD divergences piling up on the weekly, but right now the dollar still is looking okay. It's certainly in an uptrend. The yellow metal, gold, sold off this week. As did, excuse me, it's not gold, here's gold. Sold off this week with the market rising, as did silver. So I feel cautiously bullish on the markets. We are getting extended. If I look at the major markets plus, I see the small mid caps and the NYSE, the Russell, the NASDAQ, all near the top. That tells me it was a good week for being a growth stock investor. Of interest, look at the TBFs. They go the opposite of TLT. And notice they were up 6.8% on the week, while the bonds were down 6.3%. Let's take a quick look at some of the major indices. All right, we do a little bit of housekeeping here. All right, let's get some more. So we were in a box. We clearly broke out of the box. And what I see is in play right now is this. Somewhere up here around July 26th, 29th, we set the highs of the year, and I really don't want to make that yellow, so let's try that again. We are getting up to the highs, so clear this whole thing, do this one more time. So we've got highs ahead. They could be resistance. I think we're going to test those. Could test them as soon as Monday or Tuesday. That's on the S&P 500. On the Dow Jones Industrial, a very similar picture. You can see above the moving averages. I'm trying not to state the obvious and be redundant. But again, right below past highs, could expect to be some resistance there as well. On the NASDAQ composite, not quite as high up in the pattern, so a little bit more ways to go before it gets to new highs. But all of these are above the 50, above the 17 to 200. Notice the 8-day exponential starting to cross above the 50. This is a very bullish setting up picture, and there's no reason to say that this market can't go higher looking at this. Just change one of my settings here. Make sure I got the same thing done on this. Now, all right, so Russell 2000, which has been the weakest, but look at the move we had this week, breaking out, still in a downtrend. All right, be nice to see it to take out some of these recent highs up here, but it's got a long way to go to get close to where the past highs were. But it's certainly nice to see the Russell moving up and being above its moving averages. As we talked about, Alex, let's look at the Innovator IBD 50. So this is a managed ETF of the IBD 50 stocks. And notice the growth stocks from one of the references we all use with very smart money managers and good traders. Look at the underperformance versus the S&P 500. Look at the big weekly sell-off, and look how we're sitting right on the 200-day moving average. For an HGSI type growth stock investor, we probably shouldn't expect to be setting the world on fire when even Investors Business Daily can't be profitable in the market. But then again, we have the ability to buy things besides growth as well. The dollar, as we talked about, sold off a little bit the last couple of days, but it's much closer to its highs. The volatility index has come down considerably down here to a level of complacency. And with the dollar strong, the markets rising, yields falling, rising, bonds falling, no surprise you saw a sell-off in gold and a sell-off in silver. Maybe this is overdone and maybe it bounces, but right now it is what it is. All right. So I've got a sense now of what the market's doing. I'm definitely bullish. I am concerned that we're going to run out of steam soon, so I'm going to be careful, but I'm certainly not going to load up the market on shorts. Now, the next thing I do is I go down to 07, hit that button, and then of my 176 industries, you could see it's not what I wanted. Let's try that again. All right, what did I do wrong? All right, I got a filter on. Usually there's a filter on when you don't show anything, so let's see what the filter says. All right, no filter. So I had 176 industry groups. When I look at two-day force, I'm still not getting any. Why is that happening? All right. No securities. All right, I know why. I think I know why. So I'm just going to go up here. All right. You can see I've got 61 groups. Let's see how many I have here. So I have 176. I have 61 that are moving to the upside. I have 18 to the downside. As I mentioned, defensive plays, so REITs, tobacco, large pharma, beverages, household products, utilities, home products are leading to the downside. Let's take a look, since I'm bullish, at some of the groups to the upside. So the industry index is not real. That's there's no stocks in that. So number one is bank index. I mentioned with rising yields, banks, especially regional, should be strong. 5.7% move over 5 days. Right click, change to index group, and we'll take a look at some of the things that we see here. Let's go open up that window. Let's go to earnings per share growth. Let's change this to my regular view. Perfect. All right. So this is PNC Bank, and what I see here, like on many, is a break above its moving averages. You can see the industry group strength is extremely strong, starting to make a run. You could see what I call the magic line. The red line is the relative strength of the underlying versus the S&P. When it's going up, it means it's stronger than the S&P. When it's going down, it's weaker. And this is a 10-week moving average. This was put together by Chris Wilson years ago. I call that cross a magic line because it seems to be associated with a new uptrend, especially if I've got green here on and a kahuna. All right, so PNC Bank, 2.9% dividend. SVB Financial, a little bit lower in the curve. First Republic had a couple kahunas, pocket pivots starting to move up, small dividend. Weekly high close doji. This is a John Person signal. So notice that you have a doji within the last couple of bars, that we now have a day that we close above that doji. According to John's rules, you could buy at the end of the day or buy tomorrow, and this is a high probability reversal signal. So a lot of those this week. BBT's already running, KeyCore. The one that I put on my buy list, let's see where it's at. I like Bank United, just breaking out above the 200. Has some earnings coming in, 2.5% dividend. I guess I'll just say that there's a number of strong-looking banks. Axos had a high close doji and broke above the 200-day moving average. The other way to play this would be something like the KRE, which is a regional bank ETF, pays us 2.2% dividend, and it's performing just like the stocks are. All right, so regional banks are something that you might want to be playing with. Midstream oil and gas, this surprised me a little bit because they're a dividend payer, but let's just take a look. Here's Cheniere retaking its major moving averages. Pays no dividend, does have some earnings per share growth, high multiple. Western pays a 9.5% dividend, down in its pattern. It's been weak. NGL Partners, nice pattern here with a kahuna pocket pivot, my signal, mobile breakout from a squeeze, taking out both the 200 and the 50-day moving average. That looks interesting. They pay an 11% dividend. Shell Midstream, a weekly bullish doji reversal, kahuna pocket pivot, pays a 7.9% dividend. Then we get to the group. Semiconductor devices, AMD, talked about this a lot. It's sold off, but it looks like perhaps it's got something going on now. Notice how Earnings per share growth are increasing, and at least the second quarter is much higher than its multiple, under substantial demand at 5.9. Micron, rising RAM prices are projected, and you can see Micron's moving to a recent high, doesn't have the earnings per share growth. NXP, this is one that was to be acquired, never got acquired because the Chinese looks like it's starting a run as well. So there are some strength in this market as we're showing you. Next group down, communications equipments. Cisco, earnings are out. I'd prefer to buy things that are above their major moving averages and in uptrends. This would clearly fit. Don't like the red kahuna and big volume yesterday, so I'd keep, or on Thursday, keep going. Motorola Solutions has pulled back. Nothing really, get my fancy there. Steel Raw Materials, this is a group that was supposed to have benefited from the tariffs but hasn't. Vale, this is more of the ore producers. Big move off the bottom, still below the 200. I'd like to see it above it before I followed it. You look at that earnings per share growth on a stock with a PE of 7. If it meets or beats that number, you'd expect multiple expansion and a higher price. Oh, looks similar. All right. Base metals. Look at the earnings per share on both of these as we go out some. FCX, not as much, but it's Southern Peru Copper, which actually that wasn't here. There it is. Look at the earnings in the second quarter. Really picking up on a stock that trades on a low multiple, breaking above its moving averages. These are the stocks that have been moving. As I said, it's been junk off the bottom. It's hard to look at this and say this is a growth stock pattern. It's clearly in a downtrend, but it's reversed. It's moved from 8.5 up to 11. That's about 30%, even though it's in a downtrend on a longer time frame. I've heard comments about aluminum prices firming, so that might be good for something like Alcoa. Let's see if I can get us to there we are. Again, if you look at what this move has been, this is below the 200. It's clearly in a downtrend until it breaks above it. But if we go from the low here to where it closed, this is a stock that's up 39% in 11 trading days. So sometimes, even off the bottom, you can make a lot of money. Saw some interesting casino stuff, especially number 1 and number 3 and number 4. Let's take a look at them. And these are things that are interesting to me. International Game Technology, it's got earnings with some growth coming in, pays a huge dividend, and is broken above its 200-day moving average. Yes, the time to buy was down here, but hey, I still think this can run further. And look at crossing above the magic line on the weekly. I like International Game Technology. Win, I'm surprised it makes the list considering the challenges it's having with Macau. But how about Scientific Games? Kind of like International Game Technology. Maybe the casinos are starting to order more. This has already had a big move. That would be the downside. Eldorado Resorts also looks like it wants to move. It's had that weekly and a daily high close doji. Caesars bought, I think, some of the MGM properties, has broken above its chandelier stop. It's one of those stocks that is sort of flagging and looking like it's ready to break out here. It came in a weekly buy signal, no dividend there. Anything else here? So casinos look interesting. I continue to do this on my own for the top 10. Oil exploration, these could be interesting come Monday, depending on what happens with the price of oil after the Saudi drone attacks. I heard late on Saturday night that they'll be back to full capacity on Monday, so it may not be much of a blip. Here's an old leader. Cimarex. I remember this used to be on a index, E-index. See, it was $130, $145 stock. Used to be a very expensive stock, and like many of the oil companies, has fallen on tougher times. Clearly on the weekly looks like a reversal, has broken above the 50 with a kahuna. Small dividend, makes money with no earnings per share growth. If I'm looking for junk off the bottom, that's what I'm looking at. It's on my buy watch. Pioneer down a lot as well, similar pattern. ConocoPhillips 2.1% dividend. Devon, these have all been on hard times, but as I said, it's been the laggards that have been leading of late, so that's why they're showing up here. Back. Then e-commerce discretionary. Netflix seems to have weathered the Apple announcement. It's fallen off a lot since its last earnings, and the Disney, but it actually moved up on Friday despite Apple coming out with their low-cost streaming option with Apple TV. Weekly doji reversal. It's got good earnings per share growth coming, although one more tough quarter, just in time for a big January move on seasonality, perhaps. I think it's a risky play right now. My guess is it goes higher if the market goes higher. I do have a position in Alibaba. It's had a nice move off of its moving averages. Again, very dependent upon news flow and Trump tweeting. Etsy I've had in the past, still has to get above its moving averages. And Amazon, at best, I could say it's going sideways. Maybe you could say it's the lower part of its range and it's going to go higher. I just look at Amazon, I see a sleepy stock. Check's too far down. So I've gone through my stock list, and I basically came up with a large buy watch list for tomorrow or for this week. And these are the stocks that made it into my list. If we look at industry groups, you can see a lot of banks. We've got some casinos and gaming. I spent some time on those as well today. And then a smattering of other things. A couple of property and casualty insurers looked good. There were a few REITs that interested me. Almost all of them were hotels. We have Park Hotels and Resorts. It's a weekly. You can see it's reversing on that. But if we look at the daily, we can see it's broken above the 200, although it's got red bars on Friday. That was after a gap up on big volume. This is one that pays a 8.9% dividend. It's got great earnings per share growth. There was also on this RLJ Lodging, Sunstone, other hotel investors. Those that want to play marijuana, I think playing marijuana now here is tough. Here is a company that is a REIT on both warehouses and I think farmland used in the industry. And this is one that has been a relatively good performer until sold off of late. But this might be one that's reversing. If you want to be in the marijuana space, that might be a place to look at. Let's work up one stock that I like a lot for a potential purchase on Monday. And that stock is Axisome. This is a current holding of mine already, to be transparent, but it does look to me like it might be time to add to my position. So why do I like this stock? Let's look at it on the major platforms. Are we in an uptrend? Clearly we're in an uptrend, and in the last 3 months we've gone sideways and based. Here is the chandelier stop. We are right below it. We had a reversal of the chandelier on Friday, a PSAR reversal on Friday. You can see the industry group for biotech and pharma has moved up some. We had a pocket pivot and a kahuna. On the weekly, again, you can see the pullback into the averages. We're above the magic line, and we had a buy signal come in. If I go into TradeStation, I dump it into my screener. That's not what I want. I want this one. What do I see? I see breaking above resistance on the daily. I see coming out of a squeeze. I see cross of the magic line on the daily. I see a stock with a high close doji on the weekly. Breakout signal on the weekly. I see a lot that I like. So I'm interested in buying Axisome. And let's just work up how I'm going to approach it. So I do get a lot of, and I appreciate the feedback, good and bad, to be honest, because I want to make these worthwhile, because I spend a hell of a lot of time doing them. And since I have no paid customers, because I do this more as a help people than to make money, getting feedback is a positive. So if we open up a chart here, and I've done this obviously before, we're looking at axisome here, AXSM. And I know it has options because that's how I originally got into it. And I liked axisome because, well, I bought it originally down in around 10. I still have a small position left. I'm going to add to it now. Sideways move, and it looks like it's getting ready to break out. So I would not be buying it until, well, did reverse a chandelier stop. I'd probably set my buy stop to be a little bit over the high of the day, maybe 27.40, and my sell stop is probably just going to be the low of this candle down at 25.23. So that's a big. I'm giving it about a little bit less than 10%. That's a lot of range. So that's bothersome. But if we remember looking at it on the HGSI, I can probably put some moving averages on here. Add study, moving average. Let's put a 50 on it to start with. And let's make that 50, we'll make it yellow. Apply. Now I want to put a 200. I'm going to make that one yet red. Apply. Now I'm going to make a, I took away my other one. All right. So let me add that one now. So my big driver here is sitting right on the 50. I don't need to let it go much below the 50 for it to no longer apply to why I'm buying it. So let's look at options around the 25 to 27.50 range, and let's look at how we might play axisome. So I'm going to bring up my spread tool, and I'm going to pick what I'm interested in. So I'm interested in a strike price of 25. I'm interested in 2 strikes away. Min range 250. I'm bullish, so I'm going to look at long stock, long call, short put, bull call, bull put, synthetic long. And so I've done a little test here, and it's showing me the various spreads. Since I have 2 different strike options, there'll be 2, at least 2 for everything. Sometimes, and I guess there'll be 4 because I looked at both directions. Let's just look at, I'm bullish, so let's look at things going up. All right. There's a number of columns here that matter to me. Maximum risk. If I was to buy 100 shares of stock, it would be $26.84, and I would be at risk $2,600.84, but I'd have an infinite profitability. So when you buy a stock, as the price goes up, your profits go up. As the price goes to the left, goes down, your losses get bigger. So buying 100 shares, you break even at the price you bought it for, minus transaction costs or plus transaction costs. Your maximum risk is what you paid for it, and your profits could be infinity and beyond. Whoops, hit the wrong one. If I buy a call, and there's 3 different calls, you still have the infinity piece, but to buy a call, I'm going to have to pay somewhere between $3.50 for a in-the-money call to a 132, which would be a couple strikes out of the money call. The benefit of buying a call is I have an infinite response, infinite upside. All right, so I get, and my risk is limited to what I paid for that call. So I pay to own this. I can only lose what I paid for it. I have all the upside. A call is great because you can control a lot of stock. Remember, to control 100 shares, it was going to be $26.84. Here, to control 100 shares, it's $220. So it's a lot less out of pocket. That's the only margin requirement, because the most you can lose is that $220. You maintain the infinity, and I do like this. The problem is I don't like paying that much money, so let's just see what other options I might have. Shorting a put. Shorting a put says I think the stock's going to go up, so I'm going to sell you a put which gives you the right but not the obligation to sell stock to me for $27.50, and I can lose the same as if I bought the stock, which would be $24.80, because it could go to zero, which is basically the strike price minus the premium I collected. The problem with this trade, and why I don't like shorting puts in a bull market, is all I can make is the premium, so I get to put money in my pocket, so it's a net credit, but you could see there's no infinity here. It's capped at that premium, but I have potential max losses. I don't like that. All right. Then I could look at a call spread. Why would I do a call spread? So if I did a 25, 27.50, let's play with that one. Let's say I did a 25, I'm going to edit this, 30 call spread. So I'm going to buy a $25 call, and then I'm going to reduce my cost by selling a $30 call. Now the good news is all I can lose is what I paid for it, which in this case is $217.50 for 100 shares. But I've capped my gains. So if I'm very bullish on it, why would I do this trade? I would do this trade because I'm reducing the cost of getting in. I'm reducing how much it has to move for me to be positive, because I only have to move as much as I paid before I move in profitability. And in a sideways market where I don't expect a big move, this is a decent trade. I do this one routinely. A bull put spread would be, I think the stock's going up, so I'm going to sell you a higher price put, and then I'm going to buy a shorter price put to protect me, and I'm going to keep the delta, which in this case is $1. I don't like that trade. There's not as much upside. What I do like is a variation on a synthetic option. So let's just look at this. Does that pattern not look like the stock? It does. It's costing me to control 100 shares, $200. It's already $1.84 in the money. So if the stock doesn't move, I lose 16 cents. I get the same P&L curve, and I have really the same downside risk. Let's pull up the stock. And those who've been here before know that I'm going to build one more spread onto this and make it my favorite trade. Here was buying the stock. And if you have a ton of money, it's always great to buy the stock, because then you don't have time as a factor. These two curves look identical. And if I make this one a little bit scrunchier up, I can make them so they look almost the same. Okay. Now, on the synthetic stock, I'm buying a call and selling a put at the same price. Now, I can play with that. I might say, I'm going to buy a $27.50 call and sell the 25 put. Let's do that real quickly. So what am I doing here? Watch paying $200 and watch my risk of $2,700. Now I'm paying almost nothing for this, and I've reduced my maximum risk. And I have a wider range here. It takes me longer to become profitable, but by doing that, I'm giving myself sort of a plateau where I don't lose more than the investment. So that's one thing I could do, but there's something I could do that I like even better. And what I like to do even better, let's leave that at 25. Right here, the reason why the debit is high is because the stock is now $1.84 in the money. So let's make this a $27.50 both ways. I'm bullish. I'm expecting it to go to 30, 32. All right. And now I'm going to get paid $50 to take this trade. I'm risking $2,700, which is kind of what I'd be risking if I bought the stock. And I have an infinite gain, so I'm getting paid to take the trade. Now, I don't like maximum risk, so I'm going to add another option. I'm going to buy a 25 put. So now my cost of this trade is $1. For that $1 a share or contract times 100, for a $100 debit, my maximum risk is now capped at $350 compared to the $26.84 on buying the stock. My gain is the same as buying the stock. I have to go a price of $28.46 for me to break even. That's one of the downsides of doing this trade. Since I have bought that protection, I now have to make up that cost before I break even. So you can see $28.50 versus $26.84. I capture the upside, I've limited the downside, and the other thing that's happened is, since versus a synthetic, at the same price. Now I got to play around a little bit, bring this into the picture. All right. So on the pure synthetic, I got paid $50, but I risked $2,700. On the what I used to call chicken shit or Jeffrey synthetic, I paid $100. So one was a credit, one's a debit, but I've capped my risk at $350. On all of them, I've left infinity as maximum profits. So buying the stock is great if you're Warren Buffett. You could buy thousands of shares, millions of shares, and not care about the cost of a share, and you have this P&L curve. You don't have to be Warren Buffett. You just have enough margin support down to cover your loss. You can buy the same amount of stock for pennies, for $50, or getting paid $50. Yes. You can buy the same amount of stock and get paid with a synthetic stock, but you've got that or complete risk. Or you can go to my chicken option where I pay a little bit, certainly a lot less than buying the stock, controlling the same 100 shares in all three, all with infinite gain, and my trade-off is it just has to move a little higher before break even. This is the trade I'm going to take, and we'll talk about it perhaps next week. You all have a great week. Thanks for joining me, and for those that are disappointed that I'm not holding a Florida meeting, I apologize. My job has gotten very busy, and therefore I have to make some sacrifices. Take care, everybody. Oh, and I just want to call out that my bullish call of all time I've mentioned before was I met my wife on a blind date, and 2 days later I proposed, and we've had 35 years together. This is the anniversary of when I first met her, so special day for us. Take care, everybody.